use cash method. If your inventories are a material income producing factor, then you're supposed to use accrual. So cash isn't even really a concept. The whole idea is we have this phantom income and we have to pay tax on it, unfortunately, in our system. And I came up with this idea, I can't get anybody to catch on to it though, but that C corporations, instead of paying tax, would have, current tax, would have deferred taxes on, say, the first $500,000, okay? Doesn't that sound kind of good? Deferred taxes for small businesses that reinvest earnings to grow and expand. And see, my idea was that why should small business owners have to pay to reinvest money into their business, okay? And it's looking at it in a little bit different way. And I've written a couple of congressmen and so forth, and I presented Deborah Price once at lunch when we had a chamber meeting. Nobody's ever bought into it. But wouldn't that be neat? And then maybe low tax rates for some more income, another $500,000 or something like that, 15% rate. But we don't have that. And the unfortunate thing is we do have to pay tax to be able to reinvest in our business. How do we pay that tax? Choice one is flow-through taxation, and choice two is entity-level taxation. So the flow-through, which would include a single member LLC, taxes of proprietorship, includes a multi-member LLC or anything else that you have taxes of partnership, and of course includes an S corp. The income, let's say we have $400,000 of income, and $300,000 of it is in cash, but $100,000 is tied up in accrual. I mean, this is maybe, when I say cash, that we actually got our deductions, okay? and so I guess it wouldn't really be income. But this income does not have cash on the balance sheet to represent that income, all right? $100,000. So how do we pay tax on that? Well, over here, you have the owner, let's make them an individual, and they have $200,000 of other taxable income after deductions and everything. We add that on top. It flows through their personal return. We add it on top, okay? Entity level, the corporation, there's a disconnect here, whatever you want to call it. I mean, it doesn't flow through. You're taxed here at the entity level. You pay tax out here for any wages, and you get a deduction in here for any wages paid and fringe benefits, right? But for earnings that are retained in the company to grow and expand, taxable earnings, you pay tax here. And so what's better, paying it here or here? Well, if you ask a room full of mixed professionals, CPAs, attorneys, I don't know, trust officers, all that, bankers, your answer would probably be, a bunch of them would be like, never use this. Or, why would you ever use that? Double tax and all that. And I realize it's a double tax system, but we're going to talk about the myth of double taxation, because what appears to be a double taxation doesn't have to be, and generally is not if you do it right. You don't, yes, it's technically a double tax system theoretically, but you don't actually pay double tax. But you can use this system to your benefit and generally not pay double tax, or if you do, it's still to your benefit. All right? Think I can convince you of that? I don't know. There's still some people when I get done there. There's double tax though, you know, it's all. Okay, there. Okay. So let's use that $100,000 number. Here we have flow-through taxation, and here we have entity level taxation, C Corp. That's the only one. Never going to use the general partnership. Hardly ever use just a regular sole proprietorship. Limited partnership, maybe in estate planning, but in Ohio, generally the LLC is better. Valuation discounts, full shield of liability. And LLP, the way I understand it, is that it has a full shield also, so it can be used equally with the LLC. Traditionally, we saw the LLC used more for companies that did not have multiple locations and stuff, and then the professional firms with multiple locations would use the LLP because it was less cumbersome across state lines to use LLP statutes than LLC. In Ohio, just located in Ohio, there's no reason why you couldn't use an LLP. I do not see a tax difference, and I don't think there's a state law big difference, okay? And then trust, okay? I have to mention that a trust can have entity level taxation. It's just that we're not going to operate a business in a trust. We may have a trust as an owner, right? A living trust. Most ownership interests should probably be owned in a living trust for estate planning, asset management planning. And then when somebody dies, the estate owns it, and then maybe it goes into marital and credit share trust. So, I mean, trust can definitely own it. We gift to the children, and we want to gift in trust instead of outright. So trust can definitely own it. We just don't conduct a business in trust. So the only one is the C corporation that has the entity level. Page 45, I give you the C corporation rates. This book is dated somewhat in that we use 2003 individual tax rates, but in theory it's not really dated. I mean, the rates have changed a little bit. How much income is subject to each of the lower brackets goes up a little bit, but theoretically it's the same as these rates. Have our $100,000 of taxable income. Then, and this is after owner's compensation, all deductions, okay? And this is earnings retained in the company to grow and expand. We're not going to turn around and distribute it right away. We have to keep it in there to finance our balance sheet. In the C corporation, the tax is going to be $22,250. I'm going to round it to $22,000. This is the federal tax. There is no state of Ohio income tax. There's a CAT tax that applies, commercial activity tax, but it is on gross receipts, and it's going to be the same either way, okay? But there's no franchise tax, no income tax in Ohio. Other states have it, but in Ohio. And so $40,000, and then under the proposal to go to a 40% rate, $45,000, and then if we'd have a surtax, $50,000. So our savings, if we choose to use a C corporation, on the first $100,000 of income is somewhere between $18,000 and $28,000, or it could cost us. Okay, cost us up to $5,000. Now, this one I don't pay much attention to, because if we're in a situation where the individuals are continuing the 15% rate, you should be using flow-through taxation probably. I mean, if the C corporation doesn't allow you to tax it at a lower rate, the first $50,000, by the way, is at 15%. So maybe if we had enough that we took the individuals and filled them up to the 15% rate, and then we filled another 50,000 up to the 15% rate in the C, we'd be all right. But there's no reason to have it taxed at a higher rate. It's your C. One of my exceptions to using a C corporation is when there's low levels of income. Now, low levels of income might be something like 50,000 in the business, or your total income might be, say, individual filing a joint return, a couple kids, housing interest, and all that kind of stuff. You could probably have somewhere around 70,000 of gross income and not be above the 15% rate. Okay, somewhere around there, just an average. And so if you had two owners, if they were taking out 50, say, you could have some more captured at the 15% rate individually. Why use a C corporation? All right. So there is this cost here, but again, we wouldn't use it. When we use it here, $18,000 to